Hi, today is Monday the 10th of May and this is a weekly recap for our rhinos. Here this is a rhino for May. I don't quite trust the lines, the projection lines. It looks like with volatility coming off now, it should actually separate those lines. So current delta is probably correct, but I don't think this is right, or if it is, then I need to investigate why those lines are being squashed here. So on this one, not much to do. We could roll the last PCS here in the form of a call butterfly. That would cost probably 25 cents, but I think I've lost enough on this trade with only $400 times, of course, the leverage. I am on PM and I'm using I use a 1.25 leverage. So instead of just about 1%, maybe I will get 1.25, 1.3, which is below my target, but this market has been just too crazy with a market rallying and volatility coming down. I mean, it could look like a return to normal, but the underlying environment situation is not great. Okay, earnings have been good on large stakes. The package, the bonus or the 2 trillion package has fueled a lot of liquidity injections into the market, but this is not stable. This is not really safe to be bullish for too long. So here, if I look at a projection for a few days, I could actually close the trade early, but if I go for maybe next Monday, we see a 2HD, which I wouldn't like it. And as you can see, the T+7, I see those lines still being squashed, so there's definitely something wrong on this. I don't really trust this. Now, if we look, we have maybe 80 cents to gain here, 20 cents here. So if I can get the volatility to come down on the call side, with the IV skew moving towards the money, I can maybe reduce the cost of rolling. So I will probably wait a little longer. I don't want to pay 50 cents for this roll here. 50 cents minus 30, I mean it should cost about 25 cents. I could do it, but I will try and hold it the way it is for a little longer. Now, if we look at June is okay. I think it's about time to flatten delta a little bit with what we would call a reverse Harvey PCS on upper longs to raise the upper expression line, and I would get probably 1.2 delta. So that's something I could do. This late in the trade, I'm generally not really in favor of increasing capital usage, but I can do that. 16.8. I should be at 20, 22 during this cruising altitude, so 20 will be okay. So I may just go for a PCS here. And of course, I could reduce it by just paying 50 cents here. So I could even go for something a little bit more conservative, but I think it's fine the way that is. So I will probably try and get $800 is not even enough, because generally descent phase, when I start peeling off the trade, it costs some money. So I generally lose a little bit of profit potential. So I would probably need to raise it to probably $1,000 to account for the price I will pay during peel off. So this is probably what I would need to do now. Otherwise, there's nothing much to do. I mean, these trades are fairly stress-free, I would say. Now, July entered recently. The trade is, I started very far OTM, not only to get a negative or flattish delta, but also it costs less. And lastly, if I look at 10%, so if I take off about 400 points to 4,200, you see about here, I have virtually no PM capital usage. Okay, this is not applicable to Reg T. Reg T will cost 7.4 here per tranche, but really this is not costing me anything. So I will probably I don't really need a vol pop when trades are so far OTM, but if I just increase the position by another 2 or 3 Brucking butterflies just above these ones, I could actually put the shorts here. So if I go for something similar, let's say 3 minus 6, 3, this will actually come at a credit, pretty good. And I would increase the capital usage to 14,000, but in terms of capital usage on a PM basis, it's going to be next to nothing again. So I will probably do something like this just to bring a little bit more credit under the belt. $150 is not that fantastic. So what I was thinking is to do some guesstimate about a call credit spread. I can get more than $1 here on 45.75, 4600. So if I go for this, still very small, because it would be 1 for 3 or 6 breaking butterflies. I would get to $300. I could maybe go towards 2, but I would still keep the delta flattish. But if I go for 2, this is what I would look at. Before closing, let's have a look at the SPX VIX correlation and how it could affect our trades. This is the SPX correlation as it is on the close of Friday. Correlation is generally around -70, -80%. A couple of weeks back it was actually pretty good, but now it is not so good. If you look here, correlation is going positive, which is generally not a good sign. Not that it necessarily means that the market will drop, but it could be an advance indicator like it is here or here, and generally it doesn't bode too well. Maybe market punters are trying to hedge the position or are selling calls on the current positions. It's difficult to say. The SPX, the put call ratio is still flattish, not indicating the market is going to retrace soon. However, let's say this is not a normal situation. Normal situation is a highly negative correlation. If we now look at the SPX historical data, market's grinding up again, but volumes are very low, which is not great. When trade volumes are low, it means that the grinding mode could continue. We need a strong sell-off with high volumes like we saw here or there. Even though this was a mini sell-off here, the volumes were high here as well. So at this time, it is likely that unless there's a strong trigger, a catalyst to go for a sell-off, even though the market may be hesitant with low volumes, it's not ready to sell off right now. Okay, that is it for now. Sorry, I've got to cut it short because there's a lot of background noise that is disturbing this recording. I will definitely update you guys on Slack, bwbflies.slack.com. And as always, if you need an invite, just drop a message and I will send you one. Thanks for watching, and bye for now.